I'm Rich.
Excellent.
You often hear when someone's introducing a speaker, it's a great pleasure to have. Well, this is really a pleasure to have Ron with us. Ron is a special guy. He's a Renaissance man. He's a PhD from Cal, Phi Beta Kappa, and wrote a book on European history, taught history at Johns Hopkins. At one time, for a short period of time, worked for a US government agency with three letters. Those three letters were not CIA. He also worked for a guy named Steve Jobs. He was a longtime venture capitalist, and for the last 15 years, he's been an angel investor. He's prominent at the the Angel Capital Association. He's a subject expert on many things, and in addition to that PhD from Cal, as you'll get a sense with Ron, he also has a GSD. Ron gets shit done quickly and thoroughly, and it's nice when someone says they'll do something for you and they do it immediately. And that's been my experience in knowing Ron for over 15 years. So Ron, it is truly a great pleasure to have you here, and love to have. Let's start off, if we can, with your overview of what's going on in angel investing and VC investing today.
Max, thanks for the overly generous introduction. It's always a pleasure to work with you. So we started in 2020. We thought the world was ending, and people, with angels and VCs, both went back to the script of the Lehman collapse, which took venture markets 6 quarters to recover. And people assumed that there were going to be mass deaths of startups, that valuations were going to crash completely, and we're going to be in a kind of a lost period of time for between 1 and potentially 3 years. Didn't happen. We were all wrong. The venture capitalists did react in traditional herd-like ways. They fled to later stage investing. And the amount of capital going into early stage companies was the lowest on record during 2020, just about, as a percentage of venture. So the market, like to say, venture was great, $120 billion invested, but only about 5-6% of that went into startups. Angels at the same time kept investing and took up the slack. So there was not much shrinkage in angel investing. Valuations did come down. There was not the mass death of startups we had predicted. So we actually ended 2020 on a pretty strong note. And both angels and VCs say we're open for business. And when markets stabilize, I expect VCs to return to early stage investing, particularly given all of the amazing IPOs we did in 2020. You can look at the health of the venture angel ecosystem by looking at the last couple of quarters of exits. When exits are great, lots of M&A and lots of IPOs, the limited partners and pension funds want to spend more money investing in startups, and they do. So it takes about 6 to 9 months for the cycle to reverse, but I do expect by next year to see a very healthy VC investment in earlier stage startups.
Thank you. What about the pandemic? How has that affected, the angel and VC investors?
2 big changes. Well, one, I think it's around between 90 and 95% of all of us, VCs and angels, are saying we are now comfortable doing deals over Zoom. Mm-hmm. So the deals that my group did last year, I don't think we ever met physically, CEOs or management teams. We didn't walk around team headquarters. We didn't get a feel of the culture that way. But we're all investing over Zoom. Second big change is we're all doing not just Zoom deals, but remote deals. I know that it used to be the joke that angel investors would not invest in a deal they couldn't get to outside of first or second gear. Now, I would say at least a third of the band of angels deals, and this is now common for angel groups across the country, are being done outside of their territory. I am looking at deals all over the country. I was sent a deal by a senior official in the Air Force last week, as an example, knowing some of my interests, and getting deals, really from all over the country. What we've not yet done has broken the barrier for international deals, primarily for legal reasons. We want people to operate under Delaware law. We have all the legal precedents. We understand how that works. I would have no idea how to do a deal in France. Just no, and I've served on French boards, so so I know it's dangerous to do a deal in France if you're an American without the proper protections and so forth. But those are the two primary changes. But I think we're all putting our foot on the gas now. So it's a great time until the bubble breaks.
Got it. Tell us a little bit about the group that you're prominent in, the Band of Angels.
Sure. We're the oldest angel group in Silicon Valley, one of the oldest in America, about 26 years old. We have put about probably nearly $500 million to work. We typically invest in any sector as long as it's technology related. So software, hardware, fintech, life sciences, energy, space tech, and about 170 members, most of whom have been very successful business people, or like myself, recovering venture capitalists or attorneys. It's a great group. We have just tons and tons of expertise. And the thing that we do best is the oldest name for angel investing is mentor capital. Our work starts when we write the check. It doesn't end when we write the check. We're not deal guys constantly doing deals. We are trying to be thoughtful and hoping to create winners.
That's mentor capital is a great term, and the band has an unbelievable reputation. We've got a lot of people on this call that are advising startups. And what would be your advice to them? And how do you go about getting money from angels? How do you go about getting money from VCs?
Well, VCs are different. This entirely different. So, typically we have now stratified the investing world. It used to be a mishmash of things, but right now we have friends and family, for your first, 10, 15, 20K. We've got incubators and accelerators, up to about $100,000. Angels, in the range of 100 to $500,000 or $1 million, and VCs for much larger rounds. Much larger rounds means more disposable income to spend on stuff. So getting paid by angels or by the brand new startups, don't even think about it. You will take your position in equity. And I was an advisor to an early stage company I loved from St. Louis, Max, and I just got a near 7-figure check for my initial few thousand shares as an advisor.
Wow, congratulations.
Sometimes
wonderful.
That does work. My advice to companies on whose boards I serve is don't even think about paying advisors cash. Your cash is far too precious. But give equity and be generous. And then as you start becoming profitable, you can start paying real fees. For VCs, it's very different. And the best way to work with VCs is not at an individual deal level, but to become a preferred provider for the VC portfolio, which means establishing a long-term relationship with the VC fund. Otherwise, it's hit or miss. It's who you happen to know who's on a board. It's more random. I'm not discounting the importance that advisors have. That they can really make all the difference. But again, you need to figure out where you fit in. Startups who have just raised $100,000 have salaries to pay, and they are when we give money to a startup, we're giving money to a startup to accomplish metrics and milestones to get to the next phase. We're not giving them money to pay off debts. We're not giving them money for any purpose other than really marketing, sales, and growth, and finishing engineering. If you can help in one of those areas, you might have a chance of getting some cash. But just think that, are you important enough to take some of the $100,000 we've just given that startup? That's a question you really have to ask yourself.
Got it. And in terms of companies that are interested in getting funding from the Band of Angels, what's the best way for them to proceed?
With any early stage investor, the best way to proceed is by a trusted reference, a trusted recommendation. We typically get around 50 or more applications a month. 7 of those go to a screening lunch. 3 of those go to dinner and become real deals. And if we have some way of distinguishing you from all of the other companies that are applying to us, because we know somebody who says, Ron, I know the CEO, this company is great. My last deal was, for me, pushed over the finish line when a good friend of mine called me and said, Ron, I've worked with the CEO for years. He is an awesome guy. And for me, that made all the difference. So that's one way. About a third of our deals come over the transom via, just via the internet, and with no prejudice at all. You need not have gone to Stanford or Berkeley to get Band of Angels money. But what you do need to do is understand who we are. We are a late seed stage investor. And what that means is we would like to have some sense, and Steve Colby on the call here can certainly back me up, some sense that there are revenues and a customer or two, someone who can validate the business that this is important besides your mom. And so that really helps a lot. So we're not funding development. We're not funding your first experimentations with should I build a company. We're not friends and family money. You come to us when you have an MVP. You come to and you're launching that in the market, and you have some initial early success from a customer or two we can call and say, so what did you think?
Thank you. So startup hubs, we used to think everything was just here in Silicon Valley. We know how untrue that is. And you mentioned a great exit you had from a startup in my hometown of St. Louis. But globally, I know you're involved with these startup hubs overseas and are advising them. What's the status? And if you could just give us a little bit of background of what's going on in, whether it's the state of Georgia or Armenia or wherever you're doing advising in Argentina and South America.
Yeah, I've been to all those places. In fact, I was virtually in the Republic of Georgia and Armenia last week. We have a booming global startup economy. There are over 150 startup hubs around the world competing for all of our attention. The thing that differentiates Silicon Valley actually is you people on this call. And I mean that very seriously, because Silicon Valley, I would say New Zealand, I would say Israel, the UK, have the most built out ecosystems. And by ecosystems, people ask me, Ron, what's the first thing I should do when I form a startup? And my answer is contact a top tier venture lawyer, because they're your first line of defense in so many ways. By the way, I'm the guy on the board who typically hires and fires law firms. But what you guys do is invaluable. You also need accounting services. You may need, you absolutely, to build out your team, need HR services. And I've worked many years with Max. I've been thrilled with results. But you need the ecosystem of HR people, attorneys, headhunters. You need some great universities for idea generation. You need communities of practice, meetups. You need PR people who are connected to local and national and business press that tell your story. And Silicon Valley has all of these things, as does New York, increasingly Los Angeles. But there are a few places around the world that are doing a really good job, but they're not where we are yet. But their deals are maturing. Their systems are maturing. So watch out. What's going on in Tel Aviv, in Beijing, in many parts of the world should give us all pause to stay on our competitive toes.
Switching subjects, what's your feeling about the cryptocurrency, Bitcoin, investing in companies in that space?
I don't. I think we're in a bubble. We're in an extraordinary bubble. You can see the wild swings in what's been going on with Bitcoin. in the past month. We're in a bubble. We're in an asset bubble for all kinds of things. My favorite asset bubble right now is SPACs, which we can talk about. But the old saying in Wall Street was, run for the hills when your shoe shine guy starts giving you stock tips. True story of the 2000 bubble. And we're seeing the same thing. Retail investing is out of control, and it's going to hurt a lot of people, whether it's crowdfunding or SPACs or the recent, the GameStop stuff. People are out for a quick buck. The grifters are here. The camp followers, who always come after every major trend, are here. We need to simmer down a bit. I'd like to suggest Bitcoin long term, but focus on whether you're a long-term investor or you're a speculator. If you're a speculator, right now where the markets are, you're probably going to get hurt.
Got it. Thank you. We've got a couple of our EC members, executive committee members, who have questions, and I'm going to ask Joan Verone to introduce herself and ask Ron your question, please. Joan? You're here, Joan? Okay. We'll wait and come back to Joan. Rick Randell. Rick, want to introduce yourself and ask Ron your question, please?
Thanks, Max. Hi, Ron. Thank you for being here today.
A pleasure.
I'm a startup attorney, and I do a lot of safes, and I kind of prefer safes to convertible notes. I'm aware that VCs and angels are a little concerned about safes, and I saw your note in your email regarding that's one of the things that you speak about is something about how safes are unsafe for VCs and angels, and I was curious about that. I was wondering if the reason for that is because the possibility of dilution if the valuation goes way up, and is that the reason why? And does the cap not protect them adequately? And what's your recommended alternative instrument for VCs and angels?
I'm giving a seminar on the subject on March 17th.
Okay.
So it's not true that VCs and angels are uncertain or cautious about safes.
Okay.
That's not true. We hate safes. We loathe safes. For a startup, the safe has some great advantages for the CEO. It's cheap. It's a very simple one-page document. So it allows for what's called high velocity finance. But the safe was originally designed by two friends of mine at Y Combinator. They give $50K to startups. They didn't want the money going to pay attorneys unnecessarily. The safe was designed for very, very early stage companies. Now the safe is being used for much later stage deals. And my number one, I'm a governance guy. I want companies to be well managed. I want them to have a board of directors. I want investors to have some input as to how their money is being used. I want investor protections. I want a balance between what's great for CEOs and what's great for investors. Basically, the safe says, it's too early. Give me some money right now. We'll eventually figure out stuff. But the safe often says you have no rights whatsoever apart from potential reinvestment rights in the old safe. So last year, what percentage of deals did angels do that were safes? I collect the data for the Angel Capital Association, so I know the figures. Less than 3% of angel deals were safes. And there's some angel deals that say, no, we wouldn't even consider a safe. So it's all about governance more than it is about anything else.
Okay.
For a more mature company, once you're raising $1 million, you have customers and partners. You have more employees. You have relations with local community. There are many ways that you may fall into traps and have problems. Without a board, you're flying blind. I mean, a real board. And we want to help you out. We want to mature you. So that's the real reason, Rick.
And so the convertible note is basically the same thing, right? Do you consider a convertible note a better alternative, or do you go straight to a priced round?
No, about a third of our deals are convertibles.
Okay.
But with a convertible, you have a couple of things. One is a convertible is a debt instrument on the balance sheet.
Yeah.
So there's no lack of uncertainty about who owes what. Two, in angel land and VC land, many convertibles have what's called an investor side note, and I'm sure you know this. And that investor side note may specify that you get a board seat. It may specify information rights. It may specify things that any good governance would want to have. So when I do a convertible note, I always do a side note with it.
Okay.
Great.
Thank you.
Thank you. Joan Verone, you have a question, and I think it may deal with SPACs, and we had someone else who was interested in talking about SPACs, and Ron mentioned it. Joan, please introduce yourself.
Yeah, I'm Joan Verone, fractional CFO. I actually read yesterday that the UK is actually starting to allow, my video is frozen. That's the reason why my video is not on. Allow SPACs. When do you see the SPAC bubble actually bursting? Because there's actually companies, I heard, that are pre-revenue going SPAC.
Yeah, yes, it's happy days are here again. It's 2000 pre-bubble all over again. So here's the problem. Among the problems with SPACs. Number one is many of the companies that are being SPACed are companies that don't qualify for IPOs in normal circumstances, where the investment banking committee would never vote, yes, we're going to accept this as a client. Even the CEO of Goldman says we're doing SPACs for deals we never would do for IPOs. That's number one. Number two is, if you know how a SPAC works, your investors give you money and you have to find a company to merge with within 2 years, or the money goes back, and the millions of dollars the SPAC managers have spent on legal fees are absorbed by them personally. So the incentives are to find companies relatively quickly. We have been raising an unbelievable amount of money for SPACs. It's last year was 70 billion, 38 billion already in January of this year for for SPACs looking to companies to buy. There isn't an infinite supply of great companies. So market makers estimate that the quality is going to fall down of the companies being acquired. You need to buy something or you have to give that money back. So we'll buy something. And that means that the quality of those kind of IPO'd companies is not going to be very good, that they'll live and die by their market performance. And if it's a weak company, it's probably not going to be a strong performer. A professor in Florida has estimated that if you bought a SPAC, if you bought a company shares on day one when it went public, when it was de-SPACed, you would be losing 15% if you held it for a year.
Wow.
So again, we are in bubble frenzy, and as I said before, when your shoe shine guy gives you stock tips, we now have sports stars and actors and actresses and celebrities forming SPAC companies, one of whom has a $500 million SPAC. For me, that's a sign. Quietly run for the hills, build your bomb shelter. Come back in a year.
Thank you, Ron. One last question about, we hear so many pitches, and by the way, Ron is going to be joining us at our pitch force next Thursday afternoon, when we're going to have 10 seed companies. If you're interested, just go to pitch-force.com and you get some more of his wisdom. But so many of these companies are throwing out, we've got AI, ML, AI, everybody's got AI. It's like having .com, a URL. What are your thoughts about artificial intelligence?
My thoughts about it, that's the area I'm focusing on investing in myself. Right now we're shifting. The past 5, 6, 7 years was all about tools and about platforms, because there were some amazing breakthroughs around a couple of core technologies. There's something called backwards propagation, which I won't go into, but that unleashed in 2012 a massive investment wave around AI. So there's over $100 billion has gone into AI companies. We have tens of thousands of them. So there's lots of work to be done, particularly in vertical markets, where the arrow is now. It's all around vertical solutions. It's not around core technology. And it's also increasingly about the merger of some really cool things like quantum and AI. But make sure if you are investing in AI or taking stock in an AI company as compensation for your advisory services, that the market isn't filled with 20 Me Too's, that the team is truly world-class. That's super important. And that there's some market validation that your AI model works, because not every AI model works. So be prudent and treat AI investing like anything else. Is it important? Does it work? Is it oversupplied? Is the market crawling with companies just like this? And is this one the best? But I'm very bullish. I'm extremely bullish.
Got it. Got it. Ron, thank you so much for imparting your wisdom over this half hour. It's been great, and really appreciate your time and who you are and what you do in the angel community. And and looking forward to seeing you next Thursday on our pitch force. Thank you so much. And a round of virtual applause for Ron, please. Just a great job. Thank you so much. Enjoy the rest of your day.
The advice I gave you is as good as what you paid for it.
It's worth a hell of a lot more than that.
Scratch for investors, you'll get 10 opinions.
There you go. Thank you so much, Ron.
Bye-bye.
It's been a pleasure. Thank you.